Hello and welcome to QV Investors' virtual event on Discovering Your Impact, ways that you can establish your philanthropic and community impact, featuring our lovely guest speaker, Laily Pirbhai. We have discovered that more and more the topic of giving has been brought up in client meetings, where many of you have expressed a desire to learn more about the various ways that you can provide social stewardship to your communities. Our practice at QV has really evolved over the years to include collaboration with our clients' trusted advisors in various areas such as legal, accounting, estate planning, philanthropy, and beyond. We understand that your financial picture and legacy is much more than just your investable assets that you have at QV. This is why we are honored to have Laily join us today to lead us through an insightful discussion on ways to fulfill our philanthropic and community goals. Laily has been a leader in the philanthropic community for over 30 years with an extensive background in the private, public, and not-for-profit sectors. We have had the great privilege of getting to know her work as a trusted philanthropic advisor. She is someone who helps individuals and families, businesses and foundations, alongside their primary wealth advisors, discover philanthropic issues that clients care deeply about. She helps uncover the motivations and values that inform all these passions and works alongside the trusted team to find effective ways to navigate the social sector. With that, I'd like to turn it over to Laily to walk us through the agenda for today.
Thank you, Katie, for that warm and generous welcome. And hello to everyone joining us today. The QV team had a number of clients and advisors join us on the 10th of May here in Calgary at the Petroleum Club to go through an exercise and conversation on how you might navigate conversations in philanthropy with your trusted advisors. Some of you were not able to attend, or for those of you that have an interest, the organization at QV and specifically Katie suggested that we create a recording with the same content, and I'm happy to do that today. What I've included in this presentation is exactly the content that was shared through discussion and dialogue at the Lunch and Learn. And it covers an overview on giving with a specific focus, of course, on the Canadian context. I draw attention to the most common gifting types, although there are more than I list. The topic of donor-advised funds and private foundations is always uppermost in the minds of both advisors and families. And in order to get started on either type of structure, we had shared some tools with the participants to help inform the family giving cycle that I will highlight, and that will be made available to you in addition to some resources and services that I referenced at the end of the presentation. So here we go. In social change, the Milken Institute and others commonly refer to the 3 T's of giving, but I've expanded the 3 T's to 5. So in addition to the more commonly accessed time, talent, and treasure when it comes to giving, and whether these are volunteer roles, board roles, active participation in a charity event, pro bono consulting work, or sharing of your financial resources, there are 2 other T's that I thought were important to share. Your ties, both personal and professional, really are the connections that define who you are, what certain issues mean to you, and how you were shaped by those issues in your community and neighborhood. And then the testimony, where you have undergone some experiences either personally or had someone face them that you've witnessed, those also bring and bear witness to some of the stories that shape your desire for social change. Let me maybe take us to a global snapshot. In 2015, the world leaders came together to define what a greener, fairer, better world by 2030 would look like, and what issue areas would have to be focused upon. As you go through this list, the top 17 have been listed, and in no particular order: poverty, hunger, good health, education, gender equality, clean water and sanitation, renewable energy, economic growth, infrastructure, reduced inequalities, sustainable cities and communities, responsible consumption, climate action, life below water, as it were, life on land, peace and justice, and finally, but certainly not the least important, partnerships for the goals. And like your advisors who partner to serve you and your families, so also many partnerships are struck in achieving some of these social development goals. That's what those SDGs stand for, our social development goals for the world. So how does Canada fare against these goals? And a caveat on these statistics: these are simply taken from Canada Revenue Agency's files and Statistics Canada's files, and collated by an organization called Imagine Canada. So these are strictly charitable granting statistics that I've labeled in some of the same categories that were identified as the SDGs on the previous slide. As you can see, a lot of families have a focus on healthcare, religion, social services, and education. And no surprise here, right, Katie, that these are constantly the top 4 or 5 areas of concern. Now, in Canada, from a donations perspective, the environment and climate change has a smaller footprint. However, you may say, what are we doing as Canadians? Well, there's a much bigger footprint that the government might have a role to play in, but this is simply philanthropic dollars, private philanthropic dollars being contributed to some of these issue areas. So I simply wanted to highlight for you which areas are philanthropically at uppermost and topmost in mind for families with their charitable donors, charitable donations. I'm going to go into the landscape that supports charitable giving. And here are some statistics that I think might surprise some of you. There are in excess of 170,000 nonprofits and registered charities in Canada. About half that number are registered charities. And you may ask, well, why do we not know exactly how many there are? Well, the only organizations that Canada Revenue Agency tracks are registered charities. Registered charities would include schools, hospitals, universities, community foundations, and mission-based entities like the Food Bank or the Nature Conservancy or the universities. The next number I find significant as well, and these are revenues that are generated by these charities and nonprofits through their fundraising, largely through their fundraising and receipt of grants activity. And that number is close to $200 billion. This number was in 2021 recorded as being just under 9% of the Canadian gross domestic product. So that speaks volumes when you compare real estate gross domestic product at 13%, the manufacturing industry at 10%, mining, quarrying, and oil extraction at 8%. These are GDP numbers. Finance and insurance at 7%. So the charitable sector and the nonprofit sector are significant contributors to the gross domestic product for Canada. The sector employs 2.5 million Canadians. That number is roughly 1 in 10 Canadians that are actively engaged in the workforce, with about 75% of that number being women. So it's, again, a very astounding statistic that I think brings attention to the sector's impact. Volunteers and volunteer hours, again, a significant impact at just under 1.7 billion hours of time, and 13 million Canadians making contributions of time and knowledge. That is, again, a really compelling number, isn't it? And finally, in terms of donations, Canadians donated in the same year, in 2021, roughly $14 billion to registered charities. And again, these numbers are tracked by donation receipts that Canada Revenue Agency records through tax returns, both personal and corporate. So what are some of the incentives that allow people to make charitable donations? There are federal and provincial tax credits available to donors, and to qualify for some of these tax credits, one must make a donation to a qualified donee. I have that in italics because Canada Revenue Agency defines who a qualified donee is. Typically, for this audience, registered charitable organizations, public foundations, or private family foundations would be considered qualified donees. There are other qualified donees in the amateur sports world and also in the university world on a global perspective. And the list of qualified donees is available through Canada Revenue Agency's website. If you simply click into CRA, go to qualified donees, there is a listing available for those that might want to know who some of the other groups are. When you make charitable donations, in order to claim the tax credits, you can only claim up to 75% of your net income in any given year against donated charitable tax receipts. However, you can carry forward any unused donations up to 5 years from the year of claim, and up to 10 years for gifts where you've made ecological contributions after February 2014. Ecological contributions would be for conservation and easements on sensitive land across the country. And you and your spouse may combine donations in a tax return, the details of which your accountant would define best for you. I thought I would take this donation tax credit a step further with reading to you what the Income Tax Act of Canada defines as a gift. And here we go. A gift is a voluntary transfer of property without valuable consideration. And a gift is made if all three of the conditions listed below are satisfied, namely that some property, usually cash or cash equivalent, is transferred by a donor to a registered charity. Secondly, that the transfer is voluntary. So much as a fundraiser may make an ask of you, your parting with your assets is done by free will. And the third being that the transfer is made with no expectation of return. So you may have an opportunity to name a program, or you may support a new building that has a family name. Those benefits are not direct benefits, but rather recognition through legacy. So as long as there is no expectation for you to have private or personal benefit, that would qualify for a charitable tax receipt. So the organization receiving those contributions would determine the expectations and the benefit that you incur through that gift. Do I see a question percolating for you, Katie?
There will be one coming, just not quite yet. I'm writing some notes.
Okay, sounds great. So what are the more common ways of giving? Giving in this instance can be either through lifetime or through your estate, and that in other words is testamentary. Giving can be done directly to registered charities, and we've just talked about the definition of a gift and the receipting that is done by those registered charities under the definition of gift. When you make a donation to nonprofits, they cannot, or community associations, they cannot receive a gift, but absolutely there are worthwhile initiatives and programs in your community and for nonprofits that you may wish to support. Social good is not just about charitable receipts, if I may add. It's about social good. And in some instances, it makes sense to go through a registered charity. And in other instances, you may wish to have impact closer to home through a nonprofit or a community association, and that's okay too. Public foundations, where multiple sources of funding come together, like different donor-advised funds. I could have added community funds in here, field of interest funds, designated funds, are a collation of funds that you as a donor can establish with a community foundation or a public foundation that has some purpose attached to it. And we'll be talking a little further about donor-advised funds momentarily. Another way of giving is by establishing a private family foundation. Again, this is typically a registered entity that is funded by a singular person or by a single family or group of persons that are at non-arm's length. And again, I'll be talking more about the differences between donor-advised funds and private family foundations momentarily, but keeping in mind this is how giving can occur. And finally, as testamentary gifts go, you might leave a bequest in your will. You might gift a life insurance policy to a charity and designate them as owner beneficiary or just beneficiary. And you may assign your registered instruments like RSPs, registered income funds, as well as your TFSAs for the benefit of a charity that you designate. So you can do this during lifetime. Something to bear in mind is particularly the beneficial assignment can be, in some instances, irrevocable. So things to bear in mind and discussions to be had more closely with your advisors. I've created a little slide to show, I hope it's somewhat legible, but to show some of the similarities and differences between donor advised funds and private family foundations. And by putting it forward here, what I do want to initially draw everyone's attention to is that a donor advised fund is not like a private foundation in its legal structure, right? So the donor advised funds are like a bank account. Think of your current bank account or your long-term savings account at a financial institution. That is the closest parallel to a donor advised fund, but of course with some exceptions from the charitable perspective. So donor advised funds as a structure are offered by public foundations, such as community foundations, financial institutions, and some independent wealth management firms. And their management is undertaken by those offering institutions. Whereas a private family foundation is legally registered under CRA, and the filings, both annual and otherwise, are as required by Canada Revenue Agency, and there are restrictions for donations when it comes to giving, as defined in the Income Tax Act. So again, this webinar will not allow for me to delve much more deeply into what some of those limitations are. That may be for another session, but this is at that high level for comparison purposes. Setting up a donor advised fund can be as low as $10,000, and the cost of recovery or fees to administer a donor advised fund can range from 50 basis points or 0.5% upwards to 3%, which includes typically your grant making, your stewardship, and your investment management. On the other hand, if you are going to undertake to legally register an entity as a private family foundation and abide by all of the rules on taxation and filings and contributions, you would seek to do so with a much higher minimum. And I've been asked by many what I think a reasonable minimum for setting up a private foundation is. It's circumstantial for the family. It's difficult to say you can't do one for any less than a certain amount, but what you have to bear in mind is the amount of administration that it takes to establish a foundation and then to maintain the status of the foundation, to maintain the ongoing filings, to maintain the investment management and the accounting and taxation involved. So the fees have to be commensurate with the minimum that you might invest in a private family foundation. Again, these are conversations that can happen with your advisors, considering different variables that are important to you as a family. Investment management of a donor advised fund at a public foundation is typically pooled with other similar funds, and there is a board governed investment policy that establishes typically what the investment horizons might look like. Those horizons are usually mid to longer term in nature for foundation offerings that have a, say, 10-year term or 20-year term, and they're much shorter term in nature when a donor advised fund is being established for the short term. Investment management, as I mentioned, for private foundations requires that the board of directors of that foundation establish a policy and then select their investment managers based on their horizon and on their risk tolerance. I bring forward the notion of duration and distribution on donor advised funds, it might be a myth that you can only have one donor advised fund, when in fact you can have several donor advised funds depending on your charitable objectives. You might have a short term donor advised fund, or what sometimes is called a flow through donor advised fund, that is typically 1 to 3 years in nature, which allows you to distribute 99 cents if the cost recovery is 1%, right? Or you can distribute the minimum, which is 5% by disbursement quota as defined by the Income Tax Act. On the other hand, donor advised funds can be midterm, 10, 20, 30 year with a sunset clause, language that talks about the wind up of a midterm offering, or perpetuity, which in this instance means forever. So once perpetuity donor advised funds are established, they are not revocable. They cannot be undone. So something to bear in mind. When it comes to a private foundation, again, given the amount that you are investing to establish the foundation, given that there is a lot of cost and administration involved, you would likely be going forward with a mid to long-term perspective or horizon in mind. You wouldn't be establishing a private foundation for the short term. So when I talk about mid to long term, I talk about mid at 10 years and long term up from there in multiples of 10. You would be required to distribute a minimum of 5% of the assets under management with a private foundation. However, the family can elect to grant more. So these are, again, options that at a governance level you can establish within a private foundation. And finally, the family engagement advantages for both a donor advised fund and a private family foundation can be multi-generational. Donor advised funds typically offer a founder +2 succession, whereas a private family foundation can go on for 6, 7, 8 generations if the family so wishes. So a few highlights on the two most commonly used vehicles for gifting, other than gifting directly to a charity. I'd also like to add that in my experience, I've encountered a number of families who have both. So I always like to say, it doesn't have to be an either or, it can be a both and. You can have a private family foundation and a donor advised fund. And you may say, well, Laily, why would we do that? Well, your private family foundation may have a singular focus on a particular issue area. It may be reaching globally on research or disaster relief or other initiatives, whereas a donor advised fund is typically more localized. So within a community or within Canada for distributions. Is that helpful, Katie?
Yes, you answered my question. It was,
Oh, I did.
okay. Yeah, if you have a family who has, wants to get their family involved, their children and maybe adult children involved, you have a family who wants to do some short-term giving, and then you have a family who wants to do some long-term planning, whether it's at the estate level or, just annually they want to give a large sum of money. Would you recommend, it sounds like the donor advised fund is the way to go, or is it a combination of 2 or 3 of them?
Yes. So you're quite right. So for example, at a community foundation, and I suspect at some of the other financial institutions that offer donor advised funds, you can have multiple donor advised funds. So you might use a short-term fund with a small sum of money to engage children and grandchildren and to introduce the concept or to have a conversation and to maybe glean out some of the interest areas if they are young adults and their interest areas that may be different from you as a parent or your grandparents. Now, on the other hand, you might have a midterm or even a short-term fund that is going to receive your charitable contribution because of some tax planning that you need to do this year, but you're really not ready or you're really not sure who you want to contribute to, or you might be ready to contribute to a program or an initiative that is multi-year and you want to watch the progress. That might, again, be funded through a short-term or a midterm type of donor-advised fund, where you want to establish something and you're comfortable with the notion of perpetuity. That's where you might then do some legacy planning around a longer-term gift. And as you do some of these, as you create some of these funds during your lifetime, you can also then link or attach a bequest, whether it's a beneficial assignment of an insurance policy, or whether it is an estate gift through your will planning. You can attach some of those assets that you wish to have contributed to a fund that was established during your lifetime and the purposes of which you've defined during your lifetime. So there are ways to integrate living and testamentary giving with both donor-advised funds and private foundations, but more on the longer-term legacy side of things, right? So absolutely, bearing in mind, it's not an either or, it's an and. And if a donor-advised fund was set up for short-term and it has served the purpose that you wished, and you no longer think you may be needing to use it, it can be left untouched, or it can be wound up within a couple of years. It's really not costing the foundation that's hosting it to oversee anything in it, or you could simply close it up just like you would a current bank account, you know. So not an issue for the foundation, but always a good option as a variable when you want to explore certain things, you know. Does that make sense?
It does. And I have one question and more of
Yes.
a comment that I always find the title of private family foundation a little bit misleading.
Yes.
Often to me, it's the, you know, the furthest from private, because it sounds like you have to report to CRA, you know, what the purpose of it is and how much you need to donate, how much you donate each year and what your financials are. So
Yes.
for a family, how do families navigate that if they don't
Yeah.
want everyone to know what they're doing?
Yeah, you know, that is a dilemma. So anonymity is available for both donor-advised funds, and in naming a family foundation, you could choose an anonymous name. But then when you go look at the filings of directors and the distributions, because of the way the Income Tax Act is presently defined, there is the information on who the directors are and how much money is in those foundations is very transparent. Again, you know, with respect, what it allows families to do is to have a little bit more oversight on their distributions, their investment management, their legacy engagement, and they don't have charities seeking them out. Rather, the families seek out the charities in the areas that they wish to pursue. So it's a little bit less transparent, should I say, than perhaps a donor advised fund, although you could have an anonymous donor advised fund at the Calgary Foundation and choose to not only have an anonymous name, but to choose not to be published. And so the only people who would know about it would be the staff and you, right? So that would be completely anonymous. And so there's been many a founder of a private foundation who gave up on the administration of and the oversight requirements of a private foundation and wound up into a public foundation like a Calgary Foundation, established either a community fund or a donor advised fund, and did their charitable work that way, still very effectively and anonymously when they wished. So these are, again, some conversations to be had with families as part of a strategic charitable giving plan, things that we can explore.
I have one last question.
Of course.
On this, because I think it's a very important slide to distinguish and highlight the differences between the three.
Yes.
When would you recommend a donor advised fund over donating directly to the charity? What would be the benefit of setting up a donor advised fund versus going directly?
Okay. First of all, I would always direct to a charity because 100 cents will go to the charity versus 99 cents. On an average, a donor advised fund at a community foundation or a financial institution might have a cost associated at 1% per annum. On the other hand, if you want to simplify your charitable giving and you would like one receipt where you can make your donation to a public foundation and have them make, at your recommendation, the distribution to, say, 10 different charities, then rather than 100 cents going to that charity, 99 cents can go to those various charities, but you're only dealing with one receipt rather than 10. So simplification is a big piece. We've just talked about anonymity. That's another instance where if you've already been supporting, say, the Salvation Army or Heart and Stroke, and then you establish a donor advised fund and it's anonymous, you may find that you're still getting literature from the food bank or the Heart and Stroke because you were already a known donor to them during your lifetime before you established an anonymous fund. So while the fund and the balances at the foundation offering or hosting your DAF may be anonymous, because you've already been a donor, you're already in their database, right? But as a donor that is perhaps entering the arena more significantly and wishing to simplify things, those might be, not advantages, but reasons to work with a DAF as opposed to directly with the charity. I have found, though, that I'm always going to support direct giving when it makes complete sense to do so, rather than diluting even by 1%. So 1%, say $100, so you've got $1 diluting it, 99 cents going to the charity. At the end of the day, the DAFs are distributing to the charitable sector. The timing of it, the administration of it, the simplicity of it is what makes it helpful to have a structure rather than going direct. But I'm always for directly where it makes complete sense, and otherwise with some planning, use the structures that are available. And again, never an either or, both an and, so have a DAF, but also do some direct giving, right? And it's not so much about, some people may talk about the amount of dollars and the size of gift. I've guided donors to make $1 million gift directly to an educational institution rather than through the Calgary Foundation. And the surprise response to that was, but you'd have $1 million more on your books. Yes, but why not have the education institution get 100 cents of that $1 million rather than 99 cents against it, right? So it builds that trust and support and integrity across both the donors and the advisors supporting those donors. And that's my way of being very inclusive for the purposes that we are having this conversation.
Thank you, Lily.
Thank you. We've talked about some of these, but the most common gift types in Canada, besides cash, rank at the top appreciated securities, typically publicly traded shares, bonds, mutual funds, or exchange traded funds on approved stock exchanges as defined by Canada Revenue Agency. We have stock options that require a 30-day window to exercise, but again, a way of gifting shares in a public entity or a public corporation for whom you are working. Estate donations and gifts by will, we've touched on. Life insurance, and we've talked about beneficial ownership and owner beneficiary. I do want to highlight a new policy called the My Par gift that was announced by Canada Life on the 30th of March 2023. This product allows for a client to establish a single pay policy where at the outset the owner and beneficiary is a named charity. And this is again a new product in the marketplace. Most insurance policies that have been gifted historically have been on the life of the individuals and then beneficial ownership or has been transferred through a planning discussion with your advisor. The My Par gift is at the outset a charitable giving instrument, so that at a minimum of $10,000 in terms of life insurance coverage, it is available to any qualified adult in Canada, and your insurance advisors can speak more to this type of planning. But again, what a great incentive. It's yet another incentive offering by the industry. Other gifting property includes artwork, stamp and coin collections. The fair market value of this type of property has lots of guidance that CRA offers in terms of rules and receipting. So when you can look some of this up in terms of what to expect from donations of this type of property, and it's readily available through the Income Tax Act. References for both Canada Revenue Agency and Income Tax Act will follow in a slide at the end of this presentation. We've talked about registered retirement savings plans, registered retirement income funds, and of course the tax-free savings accounts where you can designate ownership beneficiary or just beneficiary during your lifetime to these instruments. When you do that, you are taking these particular assets outside of your estate, and so you're extracting them from the assets that would comprise your will. So when doing your will and estate planning, Again, you want to have conversation around what are the benefits of doing these kinds of ownership transfers during your lifetime. Can you afford to do these? What are the irrevocable or revocable instances that would apply? So some planning needs to happen with those. And of course, gifting of real estate and environmental property, ecologically sensitive and otherwise, also has some rules and guidance offered by CRA and the Income Tax Act. When we brought the sessions together with the team at QV, Katie, I was able to resource through the National Center of Family Philanthropy, with their permission, some worksheets that I know you have available for your clients and some of their advisors. But I thought I would highlight what the content of some of those worksheets will cover, so that your audience looking at this webinar will have a sense of where to begin and how to begin, identifying the values they want to reflect in their giving, the issue areas they wish to support, and what are the resources they could give, those 5 T's that I opened with. So there is a worksheet that helps you think through some of these things. There is a worksheet that perhaps spurs a conversation around the types of assets to give. So in an earlier slide, I talked about the types of property that is gifted. So here is a worksheet that can help you identify which assets you might like to give and how you might establish a charitable giving budget. The budget is simply not only for planning purposes, but also perhaps to engage younger generations or other family members. It might also be to engage like-mindedness with your the connections that you have in your neighborhood or in your network. Some other tools in the toolkit that we've shared are the different ways of giving. So you may be giving donations that have a restricted purpose versus an unrestricted purpose can be for the greatest needs of the charity at a particular point in time. We've talked about a typical designated purpose might be a scholarship fund, or it might be a research chair, where there is some specific projects that you're looking to fund. We've talked about the ways of giving through a DAF and also through a bequest. And we also had, we've referenced throughout the conversation that needs to be had not only with your family, but also with the trusted advisors around you, both at QV and through your estate planning, insurance planning arenas. We also provided a worksheet that helps you identify, once you've gone through those first few, what your priorities might be. And these priorities are not cast in stone. They can evolve with time and with issues as they unfold. Your philanthropic style is an important element of informing the kind of structure that you would establish. So here we are talking about a time frame. We've talked about family and anonymity. We've talked about simplicity. We've talked about reporting, and something that we didn't touch on too much, but an example of collaboration and leverage might be where a project may attract a match by other donors, or it might attract a match by some federal funding for that particular initiative. This happens in many areas. One that comes to mind is the Heritage Fund for the Arts, where there has been some recent leverage opportunities, so contributions made to the Glenbow Museum in Calgary as it is expanding its reach. For certain initiatives might qualify for a federal match through the Heritage Fund. So there's an example of what leverage might look like. So these are conversations, again, to be had at various points in the charitable giving discussion plan. And by all means, not just having a vision and mission for a private family foundation, but also for you as a family, you know, what you envision your social impact to look like, what is your objective, and how would you like to have it unfold? So there's some great resources or great guidance in the resources that we've shared. Here are some links to the references that I made throughout the presentation. The Canadian Donors Guide is something that's updated annually, and it's available both in print and electronically. Imagine Canada is one of those institutions that, through their advocacy for the charitable sector, collates a lot of information that is publicly available, not just to the charitable sector, but to individuals and donors and advisors. There isn't a home for the charitable sector in the federal government. There is the guidance through Canada Revenue Agency and through the Income Tax Act on the incentives and on the giving information, but there isn't a home where some of the data and the issue areas have a voice. So Imagine Canada has played a significant role in that arena. I thought to share these resources. And last, but certainly not least, my contact information, which Katie also will be sharing, but here it is. And that is my presentation today, Katie.
Thank you, Laily. That was a wonderful overview of the philanthropic space in Canada. I know over this past year of getting to know you, you've really opened my eyes to the space, and I'm excited to learn more. And I think you gave clients a really wonderful overview of the various ways to donate. And then through the worksheets that you provided, just some tools on how to start the conversation at home. And like you said, we really just scratched the surface of this very broad topic and very important topic. So if you have, once you've had time to digest the video, and once clients have had time to digest the worksheets, if anyone has any questions, please reach out to myself, Jason, or Vanessa, or Laily directly if you would like to learn more about this. And thank you once again, Laily, for your time. That was very interesting.